Hello, this is Evan Hutchison, and I'm going to go over the second part of this extended video. The first part on a previous video that we did is Maria, starting a business with the government, starting a consulting business and setting it up with the government, registering with the IRS, the Department of Revenue, the Secretary of State, then setting up a bookkeeping system, and then doing the books. And we did all that within 40 minutes. So it was a pretty truncated version of setting up the business, but it gives you, hopefully it gave you a good idea of how to set it up. Now we're going to use those books that we created to file a tax return. And we're going to do it really quickly. It's a pretty simple set of books. If you watched the video, great. If not, here's the P&L that we created. It's pretty simple. Sales of 147K, cost of goods sold of 45K, and supplies of 90,000. These are all just random numbers. We were doing a few things in the video, and this is what we came up with. So the net income is only 11,900. We're going to put all this into her tax return. She's a sole proprietor, or I'm sorry, she's an LLC. That's what we did. We set up an LLC in the first video. She's a sole member LLC. As long as you're a single member LLC or a sole proprietor, you file your business income on Schedule C. This is Schedule C. It flows to Schedule 1, and then Schedule 1 flows to 1040. So the Form 1040 is the end-all, be-all. That's the front page, that's the main page of the tax return. Everything else is schedules and forms behind it. So the Schedule C is behind the 1040. It goes to the 1040. This is the 1040. Here where you put your income. Here's W-2 wages, interest, dividends, pensions, Social Security, and so forth. The Schedule C income goes on other income. So Schedule C actually flows to Schedule 1, and then Schedule 1 flows to the 1040. So Schedule 1 is, well, we'll get to it in a minute, but here it is really quickly. This is Schedule 1. It's just a few other sources of income. They try to simplify the 1040. I don't think they did a very good job of it, but when they did it, they moved a lot of this income off of the main page of the 1040 and just created more schedules. So the Schedule C goes to the Schedule 1, the Schedule 1 goes to the 1040. We are going to do the Schedule C, and of course we'll see it on the 1040 after we're completed. So she is a consultant. She doesn't have a business name. Well, she does, but we don't know what it is. We don't know what we should call it. We'll just call it ABC Company, LLC, something like that. So you put your business name right here, you put your EIN right here, and your business address right here. She's just working from her house, so she doesn't have a business address. She's just using her home address as her business address. And from the video that we went over previously, we decided to use cash basis accounting rather than accrual basis. So if you looked at the previous video, you'll see that the accrual financials are different than the cash basis financials, and I kind of went over why. And mostly, as a small business, you'll want to do cash basis taxes. That'll usually save you the most money. So the first thing we do is enter the gross income. So the gross income, as I showed you before, was $147,000, and the cost of goods sold goes right here. Cost of goods sold. So remember, this is the Schedule C. It's basically a profit and loss of your business. You start with income, cost of goods sold, gross profit, and then all your other expenses down here. So to get gross profit, there's a little section down here for cost of goods sold. Here's cost of goods sold in Part 3. She had some labor and materials, so we can put purchases, we can call that materials. Materials was $10,000. Labor, here's cost of labor. This is really labor cost. This labor cost is really for if you have W-2 wages that you're putting under cost of goods sold. If you have employees that work for you. If you don't, she just had some subcontractors, and we called it labor on the P&L. you would just put that under other costs. So we're going to do that here, subcontractors, and that was $35,000. So she's got $45,000 of cost of goods sold. Her gross profit is now $102,000. So gross income is 102 because we took the 147 as income. We subtracted out the cost of goods sold. We're left with 102. She also had 90,100 of supplies. That's not typical. It's not typical to just have gross income and then supplies of 90 grand and that's it. But we were just messing around with her profit and loss, and that's what we came up with. So we are stuck with it. Her net income is 11,900 now. Tentative profit, it's the gross margin minus your expenses. So the 102 minus the 90,000 is 11,900. So this is what flows to Schedule 1 right here, and then this Schedule 1 flows to her 1040 right here, business income. There are a few things, so let's just say for purposes of this example, because right now she has 11,900 of income, and if you show the 1040, she's already got a standard deduction of 12,000, so her taxable income is 0. She'll owe some self-employment tax, but she won't owe any income tax. So let's put something on here. Or let's just do this. Let's say the supplies were actually 9,100 instead of 90. Now her net income is 92,900, and we can look at a few other situations. One of which, let's say, since she is working from her house, she's got a home office. So the 8829 right here, this is where you put your home office expense below the net income. Home office expense, and then net income after home office will go right here. So let's say she used her business. Let's say she has a 100 square foot office and a 2,000 square foot house. That creates a 5% home office deduction. So basically, if she has mortgage interest of we'll say 10,000, real estate taxes 5,000, utilities of 2,000. We're going to take 5% of this number and deduct it. So she gets $850 worth of a deduction as a home office expense. So that 92,000 number, that 92,900 number, the net income, now is 92,050. So she's using a home office, and let's say she also has health insurance. Health insurance, you see right here, self-employed health insurance. So you can take a deduction if you're self-employed and you pay for health insurance. But it's not going to be a deduction against your business income. It's not going to decrease this number or this number. The home office did, and of course the business expenses do. The health insurance is just a deduction you can take for being self-employed. So it doesn't decrease your net income for your business, but if you go to Schedule 1 where your business income is, there's adjustments to income down here. So it becomes an adjustment to income. Your health insurance decreases your income tax, your taxable income. Just like, if it were right here, or if your health insurance was a decrease to your business income, it will do the same thing to your taxable income. It would decrease it. But your business is also hit with self-employment tax, and the health insurance does not affect self-employment tax. So that's why it's outside of the realm of your Schedule C. Outside of the realm of your net income for your LLC. It affects your taxable income. It decreases your taxable income. So it is a benefit, but it does not decrease your self-employment tax. So that's why we put it right here. And then there's also a few other things, a few other items that go here that are pretty common. One is this one. This is the deduction for self-employment tax. So this is based on your And I've gone over this in other videos, so I'm not going to go over it a lot right here, but this is based on your net income, and it's a percentage of that, and you can take that as a deduction. And then she also has the capability of putting money into a traditional IRA or a Roth IRA or a SEP-IRA. She's got a lot of different options being self-employed. So a traditional IRA, you can put in up to a certain amount. You can take that deduction. A Roth, you get the deduction on the back end in the future. Down the line, when she takes the money out, she can take the money out free of tax, even the earnings. So Roths are great as long as as long as Congress keeps them around, which they might not, because they have such a great benefit to your tax plan. The SEP-IRA, it's a little bit different than the traditional IRA and the Roth IRA. You can put a lot more money into it. You can put around 25% of your net income up to a certain threshold into your SEP-IRA if you're self-employed. If you have employees, you're required to put money into their IRAs too, as long as they've been around for a couple of years. So it becomes a little bit more of a planning strategy when you do have people working for you. But for her, she can put 17 grand in based on $92,000 of income. So that's pretty good. An IRA, you can't put nearly that, or a traditional IRA, you cannot put that much into it. So a SEP is a great tool to use if you have a lot of money that you want to put in towards retirement. So she's going to put 17 grand into a SEP. She paid $5,000 for self-employed health insurance. She's got $6,500 as a self-employment tax deduction. So all of these total up to this $28,000. If we go over to the 1040, where are we? Up here. Oh, that's the worksheet. The $92,000 of income gets reduced by that $28,000. So she's only showing $63,000 of adjusted gross income now. She's got that home office, she's got the SEP, she's got the self-employed health insurance. One other thing that a lot of people have if they're self-employed is mileage on their vehicles. Typically, if you have a vehicle and you're thinking about putting it in the business or having it as putting it under your personal name, it's usually good to buy it under your personal name. Certainly, if you're financing it, you can probably get a little bit better rates doing it personally. And if you do it personally, you can still take the standard mileage rate. So let's just say she has a vehicle that she drove. We're just going to call it a vehicle. She started driving it at the beginning of the year. And let's say she drove 20,000 miles for the year. And of those 20,000 miles, 5,000 are business related. So we can take 58 cents per mile, so 58 cents per 5,000 for the year 2019, and she right there gets a deduction of $2,900. So that's a great benefit. You want to keep up with your mileage though, because that's of course a hot option or a red flag. It could be a red flag for the IRS because so many people take advantage of that deduction, and the number of people that use this deduction that actually keeps up with the mileage log is of course very slim. And these days there's app Mileage IQ and other apps like that you can put on your phone, and it's very simple to keep up with mileage. There's no reason really not to do it. It's a lot better to be safe in this situation. So I would have some sort of mileage log in place and keep up with your mileage, because that can be a great deduction. And this is where she is right now. So she is at 90,000 of net income, 89,000 of net income after the home office expense.